Pasha Paro, Wide at 7. Thank you for tuning. The replay. Man, I got texts from all over the place today. What's going on with the market? It's exactly what we talked about was going to happen to the market. We've been talking about this since November. So shout out to Big Boy Pep peeps, because it's Big Boy Pep for my peeps. I think a lot of us was prepared because, like I said, we've been talking about it since November. We've been watching closely. We got the magnifying glass out on all of our activities, all of our interests. We're really paying attention to everything. Congratulations to you all for another day. So, yeah, excuse me, I didn't even give you a video yesterday, but I don't make excuses. I told y'all that's why you got to hit the subscribe button, click the notification bell so that you can be notified when the opportunity arises. So, been working on a lot of things. As always, who isn't? You're busy too. That's why you're probably listening to this in the background while you're working on something else, while you're doing your project, while you're doing your craft, while you're creating your product. And you know what? That's great. Zone out with me for a minute. So everything's red. Look what Evolve did today. Evolve went and dropped 70 cents, like 71 cents on the day. So if you weren't careful, it would have gave you, it would have took back everything that it gave you over the last couple of days. See? And it actually has a pattern of doing that. If you see, it comes up and down, up and down, up and down. Now, ironically, to the pleasure and delight of many, it stayed in the channel. It's almost like these things is like having fun with us all, right? So they give you enough. It's like bait. You know what I mean? Like they give you enough to say, okay, you're feeling good, and then they find a way to recapture if you're not careful. So hopefully you got out early. If you're involved with Evolve, you got out in the early part of the day and still captured some gains, some green from your recent rise, which is what it has a history of doing since we've been watching it, and it's been entering this green area or coming close. It came up here, and then it dropped back down. It came up here, and then it dropped back down. It came up here, and then it dropped back down. The good thing we have to look forward to is that it's still climbing. It's even though it's not a nice staircase where it's up and flat and then up and then flat, it is still in a staircase function, so to speak, where the low is higher than the last low, the high is higher than the previous high, and as long as it keeps doing that, eventually we're gonna be going in the right direction over time, and we're positioning for that nice breakout once conditions favor. Vion was down 3 cents today. Again, I like this because it's a very slow moving stock in comparison. As you can see, Evolve is all over the place, and you kind of have to, pick and choose what you want to do with that. Vion has a nice pocket here. It stays really tight, and we're just waiting for the breakout with that, I think. It's relatively peaceful. It's doing this little thing in the purple box, and we're good with that. We're good with that fluctuation. 10 cents, not bad, So, not to say you sold all of your Evolve. Again, I'm not a professional. This is for your entertainment purposes. I'm not like any type of broker or anything like that, commissioned by anybody. These are just my personal notes that I'm sharing with you. Gym Pop. So we can all learn and improve and grow together. So what I want to go on today is a lot of people, like I said, I got a lot of texts, right? I got a good bit of text, and they're like, what's going on with the market? You know what I mean? And I was like, you know what? I hadn't been watching today because I've been busy all day. But but let me check out what you're talking about. So, stuff was down, stuff was red. We've seen this before. We're familiar with this up and down, and we've been watching this gradual slide for a while now. I kind of been talking to you about it since at least November, and we changed our strategies. We're being agile. We're staying current with what's happening at the moment. Okay? And that's how we're maximizing our positions. Okay? If the thing is coming down in an avalanche and you can get out of the way for a minute, you'll have a lot of rock to build when it all hits the bottom. See, when it all hits the bottom, then it's gonna want to go back up. So if you're out, the one thing we should have all learned from March 2020, right, is if you looking back on it, if you knew it was gonna drop and the whole market was gonna be down 80%, give or take, you would have took your money out and you would have put it in at 20% and had 4 to 5 times the amount of what you had available and let that ride back up, right? That's what you would have done, right? So what we need to look into to understand what's really going on, or at least have some additional understanding of what's going on, is we need to look into bonds. You see, got this article here that gives you a nice little touch on where to start with the concept. So let's take a look. Stock markets and bonds are usually go in opposite directions. During a bond market rally, the stock market drops. To make matters more confusing, the higher the price paid for a bond with a face value of $1,000, let's say, for example, the lower its yield. Meaning, like, some of you get that already, but for the people that don't, let's take a moment and help them understand so we can all be at the same level. Basically, if the bond is going to pay you $1,000 when it matures, right? If you buy it at $200, right, it'll make you $800 profit when you cash it in for $1,000, in theory, right? So what it's saying is, to make matters more confusing, the higher the price paid for a bond, the lower its yield. So that means that if you buy that bond at $500, when it matures, you only get back $500. So the higher the price paid for the bond, the lower you're going to actually make off of it. You know what I mean? It kind of sounds like it makes sense if you look at it like it's going to be worth a certain amount. So the more you pay for it, the more the less you can make. And you know what I mean? So think of it like, if you know something is only going to sell for $10 and you got company A that's selling it wholesale for $2.50 and company B that's closer but selling it for $4, you get to decide. It makes more sense if you look at it like that, right? So when the bond market crashes, and make sure I got you on the right screen, because last time I had the wrong screen up, y'all was looking at the wrong picture. All right, so when the bond market crashes, right, what happens is yields rise. So basically, how we look at stocks, if you have a stock, if you're in a stock and the market crash, you're going the wrong direction than where you want to go. You know what I'm saying? However, actually, let's look at it like this. Bad example. Let's do it again. If you're not in the stock, if you're outside of the stock and you're looking to get in, right, and the stock market crash, like we just talked about, it puts you, the more it crashes, assuming, which we know what assumption does, but for this example, let's assume that once it hit rock bottom, it's going to go back up eventually, right? Not just like go to zero, or not just stay flat low. It's going to, hit a bottom and it's going to come back up. Let's just assume for this example to make all this make sense. Work with me, people. So when the stock market crashes, it gives you a better buy-in point because you're expecting it to go back up, and you're thinking that you're going, if you buy in lower, you're going to make more because it's going to go up further. So that gives you more on the profit side. Okay, the same thing with the bond market. So when the bond market crashes, yields rise, because it would be like saying that currently that $1,000 bond is $800 and you buy into it, and when it matures, you're only going to make $200. However, if the market crashes, the bond market crashes and it drops down to a $500 buy-in, then that means you would make $500 once it matures. All right, let's move on. So in a strong economy, there's great demand for money, so interest rates rise in response, right? So here you go. Bond prices rise, stock prices drop. So when the economy is weak, companies post weak earnings, right? Like let's take a look at an example of that. Excuse me. Like sins. Okay. So Sins had an actual, there we go. So Sins had an earning report where on Thursday, they reported a Q4 loss of 41 cents per share, right? Wider than the loss of 18 cents a year ago. So basically, YTY or YOY year on year, they're down. What was it? They were at 18-cent loss. Now they're down 41-cent loss for the same quarter. Analysts polled by Capital IQ expected a loss of 7 cents. So they were expected by this company or this outfit to basically cut their loss from last year in half. Instead, they more than doubled it. You see? So revenue dropped from $3.9 million to $3.9 million from $9 million. So revenue dropped almost in half. Now, this is a company that we were really excited about. However, it does make total sense because they probably haven't been able to really sell their product, being as though they're in the actual medical industry, because aside from treating COVID, hospitals and stuff weren't open doing other things. So they lost a lot of money, which means the activities that they need to fund purchasing new equipment from Sins hasn't been going on. So Sins has been dumping all this money into R&D and development and all the expenses of getting FDA approved and all this good stuff, and nothing's coming from the pipeline in return, right? So let's get back to what we were looking at here and further develop our understanding of what's going on. So because when you understand it's not a panic, you just know how you have to adjust for the moment. All right. So, all right, let's look at this again. The weak economy. Okay. The weak economy, or when the economy is weak, companies post weak earnings and investors sell their stocks to put their money in conservative investments such as bonds and certificates of deposit. This causes bond prices to rise and stock prices to fall. When bond prices rise, yields drop. This makes money less expensive for borrowers, right? And serves to help a weak economy recover as businesses borrow money to expand their operations. Now let's look at the opposite. Bond prices drop, stocks rally. So a strong economy prompts the stock market to rally as companies start to post good earnings, right? When the stock market rallies, investors sell bonds and buy stocks, hoping for price appreciation at a higher percentage return than they're getting on the bonds. Okay? This drives the price of bonds down and moves yields higher. And then you got the quantitative easing, QE, and QE in the stock market. During the QE, corporations were able to borrow money inexpensively, which helped them post strong profits, even though the economy was still weak. Strong corporate profits result in a stock market rally. Furthermore, institutional investors were able to buy stocks on margin at historically low rates, which allowed them to make greater profits on their investments. Institutional investors' demand for stocks also helped the stock market to rally. During this period of time, both the bond market and the stock market experienced rallies. Now let's go back to the beginning of this, right? It says corporations were able to borrow money inexpensively, which helped them post strong profits. Let's not even worry about how in particular. Let's not get too focused on the mechanics of what they were doing behind the scenes. Let's just look at this statement. Corporations were able to borrow money inexpensively, which helped them post strong profits. Now, what we know about 2020 is that they were giving away incredible amounts of money to businesses to help them. So a lot of that huge surges may not have actually been because of the activities and the success of these companies. It could have been because they were dumped tons of money on them and they were able to slide income into their profit section, or they were able to make or they were able to do things that they really didn't merit, so to speak, by their own actions because they had this surplus of money. You see what I mean? So that's why it's not so much that the market is crashing. It's really just that the market may just be correcting because what we may have been looking at, and we've been talking about this since November, but for the people calling you guys up, because you guys, my peeps, are all on point, and you guys are the ones that everybody around you look to for the answers. You see what I'm saying? So when your peeps was calling you up like, hey, what's going on with the market? Now you get, with this information I'm giving you today, you can start to translate it for them. You see, it's not anything going on with the market. The market's not really crashing. I mean, I'm not saying it couldn't crash tomorrow. Like, Great Depression crash. But what I'm saying is right now, you got to remember, if all this stuff was unnaturally inflated, you see, if all this was unnaturally inflated due to the influx of capital in places where it wasn't before, where it wasn't traditionally earned, and everybody had this surplus of money, I think that's the key, right? I think that's the key. And then you got to factor in large amounts of people were home when they wouldn't normally be home, right? Looking for ways to make money when they would have had their traditional source of currency flow, their cash flow, and they wouldn't have, may not either been looking this direction as far as being in the market to begin with, or be as active in the market. You see what I'm saying? They may have just had their money put in somewhere and they would have been at work and they would have been doing a little, whatever their daily grinds are, and none of this would have been a lot of interest to them, but they developed the interest because they finally had the spare time. A lot of people wait for the moment instead of making the moment. You see what I mean? So if for all those people out there that was waiting for the moment to get into, they had some extra money, maybe. I'm not even saying that they were financially constrained. I'm just saying they had some money. Maybe they had access to this. Maybe it's been there all along. Maybe they got their stimulus check and put some money in. Whatever the case was, you had a massive influx of people who now had the time to give the market their attention when they didn't before. Then you had some people that now they could learn and be moving around money in the markets at the same time, right? The market was inflated because of the influx of cash at these high level entities, because despite how much you think the people got, you got to know that these corporations got bank from it. You know what I mean? They got big checks, and they were supposed to use them checks to help the people in their pyramid. So I'm not saying they did or didn't, but what I'm saying is they got large influxes of cash, and that reflected in their stock reports. So if we go into this article here from the Associated Press, why rising rates are unsettling Wall Street, we can get some more detail here. So yes, it's possible. Yes, it is possible to have too much of a good thing. And that's exactly why stock markets around the world are getting so unsettled. It continues that optimism for economic revival is surging following a year of coronavirus-induced misery, quote unquote. But expectations for stronger growth plus the higher inflation that could accompany it are pushing interest rates higher, right? Which is forcing investors to re-examine how they value stocks, bonds, and other investments. So if you have a slightest hunch that the interest rates on everything is getting ready to go up, well, you should maybe make some purchases now to take advantage of the lower interest rates. You might want to position yourself now before the interest rates go up so that you can actually save. Now, also, you got to consider that if they're talking inflation, right? That means that a lot of people think that inflation means that the cost of things is going up. And I don't blame you for that. I don't fault you for that. What we have to consider, we have to ask ourselves this question. Is it actually the cost of things going up or the value of the dollar going down? So if inflation could be repurposed or rebranded as deflation of the value of the dollar, then what that means is you're going to need more dollars to get the same thing, which is why when you look back historically, right now you need at least $100, maybe more now today, to buy what $2 bought you in the 30s. And it's not because the stuff costs more, it's because the dollar has decreased in value that much over almost the last 90 years. So if you feel like there is going to be an inflation response accompanied with higher interest rates, then for, I would say, anything and everything outside of a house that you may be looking to buy to position yourself better in the near future, this might be the time you want to slide into home plate before everything goes to the sky. Because if you're going to make a purchase today that will cost you $20,000 or $15,000 or $10,000, and there's going to be inflation or hyperinflation, one, that means that this same purchase might cost you $25,000, or that $15,000 purchase could easily be $20,000, or that $10,000 purchase could easily be $15,000 by the time you go to take advantage of it. So not only are you paying $5,000 more, let's say for that example, but the interest rate would go up, which means you're going to pay more interest on top of it already costing you more to begin with. Let's get back to the article. So it continues that when it tries to figure out the value for anything from Apple stock to a junk bond, the financial world starts by comparing it to U.S. Treasury bonds, which is what the government uses to borrow money. Whole nother conversation there. So for years, yields have been ultra low for treasuries, meaning investors earn very little in interest for owning them. That in turn helped make stocks and other investments more attractive. See? So you had a whole bunch of investors that wouldn't even be investing right now, or let's change that terminology. You had a whole bunch of people in the market and probably hit a spike towards the Q4 2020, right? Because all the other stuff looked like all the other investment opportunities were looking bad, were looking bleak. So they were in the stocks trying to get the most bang for their buck. And now things are shifting, supposedly. They're withdrawing, which only deflates everything in itself as well in the market. All right. So that in turn helps make stocks and other investments look more attractive, driving up their price. And that's what they're saying when the yields were ultra low for the treasuries. But when treasury yields rise, so does the downward pressure on prices for other investments. All right. Now, to look at this in more detail from an article today, 10-year U.S. Treasury yield surges above 1.5% as Powell says he's monitoring bond market. So the U.S. Treasury yields finished sharply higher on Thursday after Federal Reserve Chairman Jerome Powell said he is watching bond markets move to see if financial market conditions were tightening. What are treasuries doing? The 10-year treasury note yield 1.5%, 1.564%, climbed 7.8 basis points, right? Its highest closing since last February. And you know what happened in March. So its highest closing since last February. So if the stock market has been on a rally since April and the bond market just hit its highest level since last February, it kind of tells you what has to happen to the stock market in order for this to balance out. So when I've been saying, or, what I've been encouraging since November, that you pay close attention and start to develop a plan of withdrawing, you might be in a good position right now. And what you want to do is you want to wait this out for what we've been talking about, waiting for it to stabilize, waiting for it to find a new floor, waiting to see what the reality is. Because if we've been watching an illusion, now don't get twisted. You could obviously, we've seen it. We made a lot of money off of the illusion. We were very Hollywood this last, 6 months. Hollywood meaning we were making money off of this illusion. Like when they put that on the big screen and show that movie, they're illustrating to you something that most likely isn't quote unquote real. It's a story. It's a motion picture, but they bank big off of the illusion that entertained you. So we've been very, very, very entertained recently. Now we want to see what the reality is. So like I've been saying, part of why the rich are rich is because they can afford to wait. And what we had to do, or peeps, is pull out little by little by little, however it was for you, a lot at a time, pull out, put in a little bit, so you still got action. You can't just go away on vacation and never come, you would just suffer atrophy and you're just totally out of touch with what's going on, and that might hurt you later on when you look to re-enter. So we play a little bit here and there, you know what I'm saying? You get your little sprinkle, you know what I'm saying? Sea salt, right? But you pull out so that you can wait to see what the reality is, so that you can catch the new floor and then make decisions. You see what I mean? That's why we're not playing a whole lot right now. Yeah, we got our little bit in, but that's all you need is a little bit right now. You know what I'm saying? Until this works itself out. So, all right. The highest levels since last February, while the 2-year note yields some change. The 30-year bond, 5.7 basis points. That's nothing to sneeze at. So Powell said that the central bank would not sit back and let the financial market conditions tighten. But he suggests the current rise in long-term bond yields was not worrisome for now. So remember what we learned here, right? So in a bond rally, yields drop, right? When the bond market crashes, yields rise. In a strong economy, there is a great demand for money, so interest rates rise in response. Now, when the bond market crashes, yields rise. So let's go back to here. What they're really saying, the 10-year Treasury note yield climbed, right? 1.574. Where I get them numbers from? 1.564, right? And it looks like, I guess the current number is 1.578, so it's still climbing. All right. And its highest closing level since last February. So that means basically that the Treasury bonds in translation have crashed the farthest since last February. Now, last February translates into, I guess you could say, when the economy was at its strongest last, because it didn't need all of this assistance. I'm not saying that today's position isn't the direct success of the assistance pumped into the system, but per these reports, the last time the economy was this strong was right before the collapse because of lockdown. I'm just saying that's what the numbers say. Now, what that means is that in theory, we're going back towards a stronger economy, which would mean that people are pulling out of stocks, going into bonds and other stuff. And if that's the case, then that means that interest rates could soon be rising. Now, the question is, what is the reality? Is this being fabricated? Was the illusion what we just lived through, and all this surges in the stock market? Was that the illusion? Are we going back to the actual reality, or is this what we're going back to, the illusion? Who knows? This is why we got to play this day to day right now. The only thing that's promised is right now, people. So let's take a look at this. It kind of matches up. You see what I'm saying? So when we look at this right here, what this is, and I don't know what I just did there. So, okay. All right, there we go. That's what we looking for right there. So this is the U.S. 10-year Treasury, just like you were reading a stock chart. I guess I should give you I wanted you to see this over here so you can see what it was. And then when we go down and we look at it, right? What we can see here is here's October, November, when I started saying, you know what, man, I don't quite trust what's going on 10,000%. Okay? This is when we started. This is when it hit. Well, its bottom was here. We had a little jump, but this is when it started to actually move up. And it's been doing so ever so slightly since then. And here is where we were, at least where the bond market was, the 10-year bond price, whatever you want to say, back before the dip in March. So the stock market should technically be moving inverse of this graph. I guess everything collapsed in March, right? And then as this tried to come back up, and you saw it it fell down. And this is, if we look at a lot of our stocks, we see exactly the opposite. We see the same dip, right? And then we see the gradual, starting in like this area here in April, we see this gradual climb in all the stocks. And then we've been seeing hiccups and then the sharp angle down. And it kind of matches this chart almost exactly. So there you go. Okay. Maybe you want to grab some things now while you know, put yourself in position. But I don't think there's a lot of possibilities here. Okay. There's a lot of conversation about panic. Okay. So what we have to understand is what is the reality and what is the illusion, and is there any way for us to even really tell? And if you feel like there's not, you know, you got people jumping into commodities, you know, they're talking about gold, silver. If you haven't, look into them. You know what I'm saying? There's a lot of opportunity in a lot of different ways, and it's all based on what's happening today. So that's the whole point in being agile. Now, I'm not necessarily a fan of bonds, you know, but if that's what you want to do, then that's on you. But this is, look into this because this could explain a lot of these red days you're seeing. And like I said, or as previously mentioned, or how they be like in the show previously on Big Board Peps for my peeps. In October and November, we were talking about, you know, we got to change by this November and December. We were like, we got to change our strategy because something's coming. And this is what came. A sharp rise here creates a downfall there. All right. There you have it. Pasha Pyro, YNet7. Thank you for tuning. The replay. Big Board Pep for my peeps. Peace.